A bad credit score doesn't have to prevent you from getting a personal loan when you need money for emergency expense or to consolidate debt. But you need that extra effort to be able to qualify for the personal loan when your credit rating is really low. Here are some tips to get a personal loan when your credit rating is really low, an alternative to consider when you don't qualify for a personal loan.
Step number 1 is to check your credit score. Lenders typically have a minimum credit score requirement, and you could be rejected if your score falls below it. Many financial companies like Credit Karma let you access your credit score for free. Pull your full credit report for a detailed look at your credit behavior over the years, as this is what the lender will see if you apply for a loan. You can view your report from all the 3 credit bureaus, namely Equinox, Experian, and TransUnion, for free at annualcreditreport.com. Try to address any red flags like a delinquent account you weren't aware of or a credit inquiry you didn't approve before applying. It may take a month or two to resolve any issues, but doing so could improve your chances of approval or lower your rate on a personal loan. Step 2 is to review your financial situation. Personal loan lenders like to see that you have at least enough income to cover your monthly bills and other debt payments plus a new note payment. Lenders use debt-to-income ratio called DTI to assess your ability to repay a loan. This is the percentage of your monthly income that goes to the debt payments, and lenders typically like to see it below 50%. Calculate your DTI and review your monthly budget to see how much room you have left for a new loan payment. Ideally, the loan payment should fit comfortably in your budget and leave room for savings and emergency expenses. Step number 3 is to calculate your monthly payments. Use a personal loan calculator to see how different loan amounts, terms, and annual percentage rates affect monthly payments. This will help you understand what adjustment you may need to make to the loan amount and repayment term in order to get a payment you can afford. Step number 4 is to compare lenders. No two lenders have same borrower requirements, rates, or features, so it pays to compare multiple options, including online lenders and credit unions. Here's what to look for. Research lenders' qualification requirement like minimum credit score and maximum DTI to determine whether you'd qualify. Compare APRs, loan amounts, and repayment terms to find the lenders that offer the loan you need. Review helpful loan features such as credit building tools, fast funding, and secure and joint loan options to find the right fit. Step number 5 is to see if you pre-qualify with a soft credit pull. Pre-qualification let you see your potential loan rate, term, amount, and monthly payment without affecting your credit score. Lenders often show pre-qualified applicants multiple loan offers with different loan amounts and terms. Pre-qualify with multiple lenders to find the loan with the lowest rate and monthly payments that fit your budget. Step number 6. Apply with a hard credit pull. Once you have pre-qualified and chosen an offer, it's time to submit a formal application. Gather the documents you need to apply for a personal loan beforehand to speed up the process. This can include your W-2s, pay stubs, and financial statements. An online loan application may take a few minutes, while applying over the phone or in person may take longer. At this stage, the lender will do a hard credit check, which temporarily lowers your credit score. Assuming the lender doesn't require extra documentation, you will likely receive a loan decision the same or next day after applying. Most lenders can send funds a day or two after approval. Step number 7 is to make on-time payments to build your credit score. Almost all personal loan lenders report payments to the 3 major credit bureaus, so on-time payments can build your credit score, but missed payments will hurt it. Avoid missed or late payments of loan by adding them to your monthly budget and set up automatic payments. Now let's see the tips to get approved for a personal loan with a bad credit. Borrowers with lowest credit scores below 550 are unlikely to qualify for most personal loans. However, bad credit borrowers can bolster their application in few days depending on what the lender offers. If a trusted friend or family member has better credit and stronger income than you, they may make a good co-signer. The lender considers both your financial and credit profiles on a co-signed loan application. A co-signer can't access loan funds or payment information, but promises to repay the loan if the borrower doesn't. If you fail to make payments, both of your credit scores will suffer. A lender may offer this option only if you don't qualify for the loan on your own. A co-borrower is similar to a co-signer. Their credit and income is considered with yours on a personal loan application, but they can access loan funds, and payment information. Both borrowers are equally responsible for the loan, so late or missed payments affect both of your credit scores. If a lender offers joint loans, you will be asked to enter your co-borrower's information when you apply. Some lenders offer secure personal loans, which can help you qualify or get a lower rate. Banks and credit unions typically let borrowers use investment or bank accounts as collateral, while online lenders provide auto-secured loans. If you fail to repay a secured loan, the lender can take your collateral and your credit score will take a hit. So weigh the benefits of getting the loan against the risk of losing the account or vehicle. Many lenders let you include non-employment income on application, including alimony, child support, retirement or social security payments. Lenders prefer borrowers who can comfortably make payments, so a higher income may have a better chance of approval. It's best to ask only for what you need and can afford to repay. If a lender thinks the loan amount you requested would overextend your finances, your application is more likely to be declined. So where can you get a personal loan with a bad credit? Look for credit unions. You must be a member of a credit union to borrow from it, but if they are one of the best places to turn if you have a bad credit. Credit unions consider a loan applicant's history as a member when making a decision, which means a good relationship with the credit union could help with approval. You may also get a lower rate at a federally chartered credit union because they cap annual percentage rate at 18%, whereas rates from other lenders can reach 36%. Online lenders. Some online lenders like Avant and Universal Credit lend to bad credit borrowers. Online lenders may include helpful features like fast funding and advice to help build your credit. So what are some bad credit loans to avoid? Predatory lenders take advantage of consumers with low credit scores who need cash by charging high interest rates for no credit check loans. Though you can easily get a short-term loan from one of these lenders, they may intentionally make their loans difficult to repay, effectively keeping you in debt. Stay away from payday lenders. Payday loans are small loans of a few $100s that you get without a credit check and agree to repay along with a fee on your next payday. Payday loans are notoriously difficult to repay because of the fees, which are exorbitant, about 10 to 30% per $100 borrowed, according to Consumer Financial Protection Bureau. Borrowers who can't repay payday loans typically take another loan to repay the first, thus entering a cycle of debt. Stay away from high-interest installment lenders. A high-interest installment loan can be just as damaging to your finances as a payday loan. These lenders charge double or triple-digit APRs on loans for a few $100 or $1,000 with terms between a few months and few years. If a borrower can't make the high monthly payment, the lender may offer to refinance the loan and extend the repayment term. This process can be done multiple times and result in the borrower paying as much as in interest as the amount borrowed, if not more, according to a study from the Center for Responsible Lending. Subscribe to our channel so that you don't miss any of the videos on personal finance and you get notified.